The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin, Jeong. Now, selecting the right ETF can be one of the most critical decisions for investors aiming to build a robust, diversified portfolio. With thousands of ETFs covering everything from broad market indices to niche thematic strategies, the challenge isn't access, it's clarity. While ETFs are praised for their cost efficiency, transparency, and ease of trading, not all are created equal, and choosing the wrong one can compromise your investment goals. So how do you navigate the overwhelming universe of ETF options? What key elements should you prioritize when filtering your choices? And how do investor-specific factors influence the selection process in a practical, actionable way? Well, to find out more, joining me now is Steve Brice, who's the Global CIO at Standard Chartered. Steve, welcome back to the show.
Thank you so much, Hongbin. Great to be here.
All right, Steve, what's the first question an investor should ask themselves before choosing an ETF?
So I guess the obvious place to start with choosing an ETF is what is the type of exposure you're trying to get to. So obviously ETFs are very popular when it comes to equity markets. So which market are you trying to get exposure to? Would it be the US, Europe? Would it a specific sector exposure, such as technology? That's sort of the starting point, because then you can obviously start narrowing down from the over 10,000 ETFs that are out there to trying to get to something that's more manageable.
Well, as you mentioned there are over 10,000 different ETFs. I mean, there's so many different ones to choose from. So, Steve, would it be a safer bet to stick to the more popular ones, the ones everyone invests in?
So I guess another way to think about popular is the ones that are larger and have more liquidity. And that's definitely a key part of our ETF selection process. They're generally, if they're larger, they have more liquidity. The price discovery is easier. The spread between the bid and ask is narrower, so it's cheaper to buy and sell the ETF as well. So definitely one of the lenses that we look at.
Well, Steve, given the concentration risk in indices like the S&P 500 and NASDAQ, what are the pros and cons of using equal-weighted ETFs or sector-focused ETFs as alternatives?
So, yeah, this is actually quite a complicated question, right? I mean, equal-weighted basically then, so if you have an S&P 500 equal-weighted index, basically around 2% will be invested in each stock. But the S&P 500 itself is actually market capitalization weighted, which has a much higher concentration. So if we look at the pros and cons, I guess over the long run, the equal weighted actually has outperformed the market cap weighted index by a significant margin. So since 2000, that outperformance is 200% of the initial investment. So it's not small. You do get some benefits from being diversified. I guess if you want specific exposure to the companies that are larger in the index and by definition have been successful historically, doesn't mean they will be in the future, then obviously the market cap weighted indices would be better. I think the other thing to just think about is the drawdown risk. Although the risk between the equal weighted and market cap weighted is different circumstances. So if you look at the 2020, the drawdown from the COVID crisis, the equal weighted underperformed. I guess that was because it was a broad economic weakness. So it hit everything. And maybe those that had more of a tech focus benefited from lower interest rates, whereas in 2022, that was the reverse. We saw interest rates go up and then the market weighted underperform. So if you're worried about weakness, think about what might generate that weakness, and that might help you decide whether to be equal weighted or market cap weighted.
So what are the key factors you look at when, evaluating an ETF beyond just past performance?
So obviously the first thing is to look at is the tracking error. Obviously the ETF is trying to mimic an index. It can never do that perfectly, but the closer it is, obviously the better. At least you're taking less tracking error risk. So that's the first thing. I think another thing just to think about, and it's related, is how are they trying to replicate the performance of the underlying index you're trying to get exposure to? Some have very complex processes here using derivatives and things like this. Generally, we prefer physical ETFs, i.e. ETFs that invest in the underlyings of which the index is made up of. That's less likely to lead to significant challenges over the longer term.
Okay. So one of the things you should consider when choosing an ETF is, tax efficiency of the ETF. So, Steve, why might tax efficiency be one of the top things to consider?
I guess, obviously, nobody likes paying taxes, right? And so if you're paying taxes, then obviously when you don't need to, of course, obviously everybody has to pay taxes in some circumstances. If you're in an ETF that you have to pay tax on before you get the capital gains or dividend distributions, etc., then clearly that can be suboptimal in some jurisdictions. So one thing to consider is, where is the ETF based? Is it a UCITS compliant ETF or is it a US based ETF? They can have significant implications when it comes to tax optimization.
Right. Now, expense ratios can vary even among ETFs tracking the same benchmark. So how much weight should investors give to this, especially in long-term portfolios?
Well, obviously, one of the main reasons that people use ETFs is to minimize costs, right? So we know that mutual funds are more expensive. They have the chance to obviously outperform if the fund manager does a good job. ETFs are really just saying, let's not pay all the logistics that go behind there, and let's just benefit from a rising market. So from that perspective, expense ratios is pretty important. Obviously for narrower exposure, so we're talking about broad market exposure, whether it be US, Europe, or emerging markets or Asia, that's definitely something you should look at. If you're looking at narrower sector exposures or even thematic exposures, we tend to not look at those, not to pursue those too much, but if you did, then you would expect the expense ratios to be significantly higher.
Right. So for investors with limited capital then, Steve, how can they identify ETFs that offer low minimum investment thresholds without, sacrificing quality?
This is an area that's obviously been growing quite dramatically as people try to democratize the investment process, make it more accessible. So we do have ETFs out there that have low minimum investment thresholds. The easiest way is obviously to do a Google search or a ChatGPT search to find out what those minimums are and then go through the normal process. I guess there's likely to be some sort of trade-off between liquidity size and efficiency of these things relative to the regular investment thresholds. But so it's just a trade-off between all of the factors.
All right. Well, there are three main ways to invest in ETFs now: lump sum, dollar cost averaging, or value cost averaging. So, Steve, how do each of those work, and how do you determine which method is best suited for you?
So the theoretical best solution is always lump sum.
Okay.
The reason for that is, on average, markets go up 2 years out of 3, so therefore investing as early as you possibly can, the better. But I use the word theoretically because we are irrational human beings who have our own behavioral biases, and therefore the key for us is to manage our own emotions as we go through the investment journey and stay invested. So then you have the two others that you mentioned. So dollar cost averaging, that's just a fixed dollar amount every month. It's very programmatic. It's very simple, obviously, from that perspective to pursue. And then you've got value cost averaging, which is actually quite an interesting tweak of that. So it basically assumes that you have a path of outcomes that you want to pursue from an investment perspective. And so when you're lagging those outcomes, you invest more. And when you're ahead of those outcomes, you invest less, which has the benefits that you buy more when it's lower and you buy less when it's higher. So from that perspective, you're doing exactly what say we should do, which is buy low, sell high. But as recent experience shows, often people do the reverse. So that can be an interesting opportunity and strategy as well.
Okay. Well, between those three, you did say that lump sum is the best here, but is there one approach you believe works best in today's market environment, and why?
I guess I use a sort of a hybrid of the dollar cost averaging and value cost averaging approach. We have a fixed dollar amount each month that we want to invest into the market. But then when markets go on sale, we increase that amount. So, for instance, in April, we doubled the amount that we invested in the market. And now we're coming back to, obviously, markets getting closer to all-time highs. We'll go back to the regular monthly investment. So that's the way that we approach it.
Are there any market signals or personal milestones that should trigger a reevaluation of, one's ETF investment strategy or timing?
So I guess one thing that you should be doing is you should be watching out for drift. So if a market outperforms significantly other markets, then you'll see your asset allocation or the relative allocation to different ETFs changing significantly. So that's the first thing to watch out for. The second thing is if you're looking at very narrow exposures, whether it be sector or thematic. The key thing there to watch out for is to really risk manage those. They're not part of what we would call as the foundation portfolio. They're more opportunistic in nature, therefore they need more active monitoring.
Okay. In your view, then, what are some of the most common mistakes investors make when starting out with ETFs?
Leads on from what we just talked about, right? Often people focus too narrow, right? So they look at their exposures. They will look at a theme and invest a lot of money in that, or they'll look at a small sector and invest a lot of money in that. Really, the key thing is to build a diversified portfolio for these, and that's what can build your foundation. At the other end of the extreme, you have sort of analysis paralysis. So people really just struggling to get started. And I think the key thing here is, we can over-refine or become too theoretically precise, but actually, even approximately right in the space of investing in ETFs, I think decent place to be. So don't try to overthink it.
All right. Well, if someone wanted to build a diversified ETF portfolios with just 3 to 5 ETFs, what mix of regions or sectors would you recommend today?
So, I would always build a very diversified portfolio, but you can actually do that in the equity space pretty easily with even just 3 ETFs. So you could just say, okay, I want a US ETF, I want a European ETF, and then I want an Asia or emerging markets ETF. And if you get that, you get, pretty good coverage of equity markets. It may not be perfect, but it's certainly simple and something that you can achieve relatively easily and quickly.
All right. And before we let you go here, Steve, how frequently should investors review and rebalance their ETF portfolios, especially in this, fast-changing global market?
So I guess in normal environments, we'd say at least annually to sort of think about that drift element we talked about earlier, so the changing asset allocation just due to performance. At most, we'd say probably quarterly. And obviously, if markets are more volatile like they have been so far this year, maybe shift to quarterly or semi-annually. But just, again, don't overthink it. If allocations are less than 2 or 3% different than the starting point, probably not worth doing too much. If they get above 5%, then it's probably then worth rebalancing because that could have a material impact on future performance.
All right. Well, thank you so much, Steve, for your time and your insights today.
Thank you so much, Hongbin. Take care.
Thank you. That was Steve Brice, Global CIO at Standard Chartered. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.